Hi, this is Jeffrey Cohen, Chicago Quantum, and I'm investment advisor representative for U.S. Advanced Computing Infrastructures Incorporated. We're an Illinois money manager that does quantitative analysis for large investment houses, hedge funds, private offices. And so I was asked, hey Jeff, what are the steps to a life of wealth? How do I invest long term in the stock market and make money? You're making all these videos talking about the stock market crash. Tell me how to make money. Keep it simple. Tell it to me like I'm your friend. Fine, you got it. So, there's 3 things that you have to do for a life of wealth. And after that, then we'll talk about investing. And by the way, the tips I'm going to give you for investing don't make me any money. Don't make money managers any money. There's no pump and dump. In fact, you're going to love it. It's just going to make great sense for you. So, the first thing you do is work in the field of your passion. For me, it was consulting. It was information technology consulting. It was IT infrastructure and IT architecture and large-scale financial services software. I loved it. I loved the people side of it. I loved consulting. I loved doing projects. We did stuff that would make your head spin. I loved every day of it. The point is, I worked really hard at it. I used to come in on the weekends. I used to just do everything I could. And so over time, I worked hard to lift that salary and bonus as much as I could. There was one jump I made where I almost doubled my income. There was another jump I made where I made an extra $100,000 a year. I want you to think about this because you'll see choices and options as you're doing your job. If you work really hard at your passion, the assumption is you get really good at it and people will pay you what you're worth. Number 2, continue with school as much and as often as you can. Keep learning. It actually helps a lot with number 1. So let's say you're a consultant. Then you go back and get your master's degree, a finance degree. Wow, you're a better consultant. We're going to pay you more. Go back for that PhD. Go back for that second master's degree. If you want to be a lawyer, you got to go to law school. You want to be a doctor, you got to go to doctor school, medical school. But even if you want to do landscaping, and you want to do indoor horticulture, let's say for cannabis. I know someone that would love to do full-time cannabis work. Well, guess what? There's schools for that. There's Oaksterdam. For those who know, that's cool. For those who don't, it's in Oakland, California. It's really cool. So keep learning. Get your certificates. Keep training. Keep trying new things, right? It helps. Number 3, it's really important. Find the love of your life. Get married. Stay married. Full stop. Divorce is hell and very expensive. A married life is a happy life, but it builds wealth. You also get a ton of tax benefits. But the truth is the tax benefits aren't the half of it. You're happy and you make better decisions together with somebody else that you trust. So you've done those 3 things. Now let's say you're listening and you're 15 years old or you're 18 years old and you're like, Jeff, just finished high school. I know someone. Just finished high school. So what I would say is, I know you got a new job starting in June. Work really hard. Show up on time. Put in the sweat. Learn. Be helpful. Guess what? They might give you a couple bucks more an hour. Next thing you know, let's say you're in a certain field, try to go back to community college for 1 class on it. Then tell your boss, hey, I took a class. I love this job so much, I took a class on it. Well, guess what? You might run a crew someday. That's great. So take someone who's 25, right? You don't necessarily put a suit and tie on, but you work hard. You're in a white-collar job. Think about that master's degree, right? Work really hard. Learn your craft. Have a YouTube channel. Have a Facebook channel. Do LinkedIn. Do Twitter. Get known. Meet other people in your field. Go to lunch. Have drinks. Have coffee. Build your network. Next thing you know, you're going back to school maybe. You're meeting a lot of people. You're getting all those opportunities. And the whole love thing is so critical. If you're lucky enough, I'm lucky. I'm very lucky, and so I hope you are too. All right, so you done that. Yay, Jeff, I did it. Now what? Now here's the investment tips. Oh, are you ready? Drum roll, please. Save every dollar that you and your spouse can. By the way, if you're in another country, save your own currency. You don't have to save US dollars. Pay off any debt you have. If you buy a house, pay down your mortgage to zero. If you have a car, buy it out. If you have credit card debt, pay it off. School loans, pay it off. Get used to paying off debt. Get used to living off your income. Don't spend when you have a choice. Be frugal. By the way, if you're married, it's easy. There's things you can do that don't cost a lot of money, right? You go out for a nice dinner with a picnic basket. You don't have to go to a fancy restaurant. Shop sales. By the way, hold on to your cars and your houses. Every time you buy and sell a house, it's super expensive. Not to mention, you got to furnish the thing. And celebrate your savings. I can't say that enough. You put $1,000 in the bank together. Woo, have a party. Every $100 that you could pay down your mortgage, celebrate it. But write it down. Make a sticky note. Celebrate savings. Set a target every year. Oh, I want to have $1 million. Well, how are you going to do that? You start with $10,000. Save $10,000. Let's check that list. Number 2, invest your money in passive U.S. and global stock and bond indices and funds. That's a mouthful. Let me explain what I mean. There's a thing called the S&P 500, Standard and Poor's 500. That is the 500 largest, most valuable, most representative companies in our economy. Okay, and every dollar you put in goes into the companies in that index in proportion to what they're worth. So you're not putting money into silly places. You're putting money in where other people think it's worth money. Now I'm showing you the S&P 500 since 1928. So if you would have invested money in 1928 and you would have ridden up the stock market boom, and then you would have ridden it down. Then you would have gone up, down, down, up, down, up. Oh, that's a lot of up. And then a little hiccup, and then a lot of up. So the truth is, the S&P 500 goes down, and it goes up. It goes down, it goes up, goes down, goes up. It's got a couple really good attributes. So if you can invest in the S&P 500, you do that. And by the way, it's very cheap. There's index funds, Vanguard, Fidelity, your investment manager probably has it. They're not very expensive. It pays a small dividend. It's passive. Now, if you wanted to take a little more risk, here's the NASDAQ Composite 100. Now, if you would have invested in this since 1971, pretty flat. Growth wasn't really a thing. And then it ramped up and it never looked back. I'm not going to say it's going to keep going, but had you invested in tech, American tech, we have a culture of innovation. Now let's look at small caps, Main Street. These are 2,000 small but interesting companies that you put $1 in and it spreads it out over 2,000 companies. Well, you look at this, if you would have started investing in 1987, it would have gone down. You'd have been crying. Goes up, goes down, goes up, down, up, down, for the COVID. No, that was 2008. That was a housing crisis. Up, down, up. You get the point. So what's happening is that these indices reflect the value of the U.S. economy. Now, lately it's down, and that's because people believe that the economy is in big trouble. But if you take a look at it, just like any other crash, it's probably going to go up eventually. And here's what happens. If you go back to rule number 1 and you save every dollar you and your spouse can, imagine if you would have invested money when the S&P 500, the Russell, the NASDAQ if you would have invested it when the market went up and when the market went down. So what happens is, if you happen to have had extra money in 2008 and you put it in 2009, 2010, oh my God, you did great. You bought it at 1,000, you sold it at almost 4,000 or maybe 4,500. You quadrupled your money. This is a generational thing. This is from 2009 to 2022. In 13 years, you could have quadrupled your money. Now, if you bought a little bit every month, right, when it goes down, you get more shares. When it goes up, you get fewer shares. So you just keep buying it. We recommend that type of dribbling all of your savings into investments, extra money, and then letting it accumulate, and then having it earn dividends and keep going. And we like the S&P 500, the NASDAQ, and the Russell 2000 for a very specific reason. So we pick, I'm showing you a spreadsheet that was produced today, actually last night, by our model. We don't, we're not messing around with it, right? So this is what you get out of the model. And I want to show you 3 rows. Now, I'm not going to be technical at all, okay? This is the most non-technical talk I've given you. I even told you to go get married. So let's see if I can keep it simple. These are the best stocks in the United States to buy and hold. Woo-woo! They have the best possible return and the least amount of risk as an individual stock. Okay? So let me make sure I understand, Jeff. So I don't want risk. No, you don't want risk. Because when you need the money, you're going to see later on, you sell the stocks when you need the money, right? Let's say your son or daughter is going to go to college. Let's say you're going to go back to college or back to grad school. You need the money. You need to have that money. Risk is bad. Safe, steady Eddie, make money every day. That's great. That's why people go to work, so you get paid every day, right? Or once every other week, let's say. So these are it. These are the best ones. Oh boy, Jeff. By the way, I probably shouldn't be showing you this because this is the secret sauce, but that's okay. For you people, you got this, okay? So you have a semiconductor company, you have NVIDIA, which is another chip company, and then you have the QQQ, which is the NASDAQ Composite 100. I showed you that before. That's this one. NASDAQ Composite, whoop, through the roof. That is the 3rd best stock you could own in the whole market, a whole thing. The 5th best stock you can own is the S&P 500. Oh wait, I think I showed you that one too. Right here, S&P 500, a little more lumpy because this is investing in real companies, not just tech. And then there's your Russell 2000, which is the 8th best stock of all the stocks. This is what the Russell looks like. It's up, it's down, it's a little wobbly, right? So sometimes you buy it and it's low, sometimes it's up. But my point is, how many stocks is in this spreadsheet? This spreadsheet is all of the profitable companies that passed extreme data validation steps and had market cap of over $500 million. These are the good stocks. There's 1,960 of them. Out of 1,960 stocks, one of them's the 3rd best, the 5th best, and the 8th best. You're not going to do better than that. And I'll tell you from personal experience, I invested a tremendous amount of my savings in the S&P 500 all the time. I did all these things we talked about. I got married, paid off all the debt, I shopped sales, saved my money, I held on to my cars until they broke. We celebrated savings, invested my money in U.S. stocks, but I also invested some global stocks, not individual ones, but like the S&P 500 for other countries. So the Nikkei and the DAX. So normally in your mutual fund company, it'll say things like European passive investments, passive equities. And we also like bonds. So if you, let's say, had your money invested with what they call fixed income, you might buy bond funds. corporate bond funds, government bond funds, high yield, investment grade, inflation protected, it doesn't matter. Try to find bond funds that are different names. Corporate, government, taxable, non-taxable, municipal bonds, regular bonds, doesn't matter. Just get a bunch of kinds. And when you can, so let's say your company has a really good 401k, or you're with a big fund like Vanguard, Fidelity, or any of those, BlackRock, whatever, diversify into other asset classes when you can. You don't want to do a ton of this, but you want to do some. So real estate. There's companies out there that own homes and that own apartment buildings and that own commercial real estate. And when you invest in them, they buy and manage all that real estate for you. You make money on the rent payments and also when they sell the properties, hopefully for a profit. Metals. Buy funds that have gold or silver or platinum or copper. It doesn't matter, right? And there's companies that mine those. Buy U.S. government savings bonds. So that may sound silly, and most people can only buy $5,000 a year. Generally speaking, they're a really good deal. They pay a much higher savings rate than you would if you bought treasuries, like Morgan Stanley has to. Morgan Stanley isn't buying government savings bonds. The savings bonds are great for regular Americans. If you live in another country, your government probably has savings bonds too. Only when you have a lot of money invested, only when you've been doing it and you have a lot of money. Then consider active money managers like us. Right now, we have a third of our money invested in active money managers. They're actually hedge funds. I love it. Market goes up, market goes down. I'm betting on the smarts of a team of people. This is important. Depending on your age, put more in stocks and less in bonds. So when you start out and you're 18, put it all in stocks. When you're 25, all in stocks. You hit about 30, 35, you start maybe putting 20% in bonds, 80% stocks. By the time you have gray hair, maybe it's 50-50. By the time you're getting ready to retire, maybe it's only 20% in stocks or 25 and 75 to 80% in bonds. And hopefully, when it's time to meet your maker, you sold all the stocks and all the bonds and you lived a good life, right? The third thing is important is this. Oh, so by the way, there's none of this Twitter stuff and following the trends. So what I'm showing you now is a pyramid of different portfolios to give you an edge on the S&P 500. But by the way, you have to look every week, sometimes every day, sometimes every month, and you have to change things around, buy and sell things, work on the tax issues. Do you really want to do that? Do you really want to know who BMBL is, Bumble, dating site, or B. Riley, or SI Time, or the Trade Desk? No, you don't. You don't want to buy stock in Dillard's and Max Linear. You don't even know who these are, right? Shopify, S&P 500. The edge that we give to clients is not worth having to learn all this. You're better off work hard at what your passion is and work on raising your salary and bonus as much as you can. Don't focus on an edge on these types of things. And so I guess that's it. I'll just give you a little personal anecdote here. Sell your investments when you need the money to live. Don't sell them otherwise. Don't try to time the market. Don't guess. So if you have to buy a house, honey, we just had some babies. Let's go buy a big house. Okay, that's a good reason to sell your stocks and bonds. You need to pay for major events. Son or daughter's getting married. Someone's going to college. Medical expenses. Do that. Hopefully you can wait a very long time and live on your income so you don't have to worry about living on your savings. So I want to show you what we did. One of these rules we followed and one of these rules we didn't. And I want to discuss it. The first is we bought a lot of stock in the early 2000s. We bought them right around 2000. I had a good job back then, real good job, and I did okay. I bought a lot of stock, and then right around 2010, I got divorced, and so right at when the S&P 500 was at 1,136, I had to take all the money, split it in half, give it to the ex. That's fine. It was half of hers anyway, right? I kept all that money in the S&P 500. So at that point, it was at 1144. Now in 2012, at 1365, I made maybe 20% in 2 years. I had to buy a house. It's where I'm living now, right? I wanted to pay cash. I didn't want a mortgage. So I sold all the stocks. I got out, bought the house, felt good, right? I felt bad that I had to sell all the investments, but truthfully, I got a 58% discount on the house from what the last guy paid for it because we were in a recession at that time and there was no one else to buy the house. So the fact that I came in with cash, didn't need a mortgage, it was golden. So the rest of the money I kept in, remember, $1,400. I recently sold it at about $4,500. I did that last year. It would have been like October, November, and it started in August. I actually started selling in August at $4,400. So maybe I did sell it around $4,400 or $4,500. The reason I did that was because I thought the market was too high. I timed the market. I saw the crash coming. I'm sorry, I broke the rule, but I'm in this business every day. I understand. So I sold half of my stocks. You know what? I had to write a big fat check to the tax man because I paid $1,400 and I sold it at $4,400. I more than tripled my money. I paid a heck of a lot in taxes. Market went up 46, 47. I was kicking myself. What did I do wrong? Did I miss it? Am I not good at this? But now at $3,900, I feel pretty good. I'm sitting in half cash. All the money's in the bank. We're good. So that's a real story. I sold investments that were low. I'm on video, hon. I sold investments that were low in order to buy a house and then rode them all the way up. And then really at the market, what I see as a market high, market top here, made that sale. But I would say do not try to time the market because at any point here, the market goes up and down and you wouldn't have known necessarily. So again, I'm just going to review. This video is really for you. It's an answer of a question. The 3 steps to a life of wealth. Work hard at your passion and work to lift your salary and bonus as much as you can. That's how you're going to live. Continue with school as often as you can. Keep learning. It helps. Find the love of your life. Get and stay married. And once you've done that, here's the investing tips. Save every dollar you and your spouse can. Save it. Pay off all your debt. Have no debt. Be frugal. Don't spend. Shop sales. Hold on to your cars and houses. Celebrate savings. Number 2, invest your money in passive U.S. and global stock and bond indices and funds. If you use an investment manager like a Vanguard or a Fidelity or a Franklin or T. Rowe Price or any of those, Invesco, BlackRock, State Street, doesn't matter. Just tell them I want the passive ones. I want the ones with the very low cost. Big funds, S&P 500, NASDAQ, Russell. And for bonds, just mix your money across them. And when you can, when you're lucky enough to have it, diversify into other asset classes, some of your money, into places like real estate, metals, and U.S. government savings bonds, which are great for the individual investor. Only when you have a lot of money to invest, $500,000, $1 million, that's when you should consider active money managers, like us. By the way, the older you get, the more money you should put in bonds and the less money you should put in stocks. But when you start out in life, all your money right there, right in stocks. And then finally, only sell your investments when you need the money to live. And hopefully it's in a very long time. I want to thank you very much for watching. Appreciate it. I'm in the business of trying to pick every up, every down, find every edge in the market, study the details, but you don't have to. This is the easiest way I know how you're going to make money and live a wealthy and happy life. This is Jeffrey Cohen, Chicago Quantum. Take care. All right, I'm done.